Hey everyone, it's Imran back again with another macro options spotlight. All right, so US indices obviously everything was closed yesterday for Memorial Day. So just taking a look at what happened last week, we did see US stock indices finishing up, led by tech. Obviously, Nvidia came out with blowout numbers, up 25%. So it was all Nasdaq really. Nasdaq was up 3% and a bit on the week. S&P small green. You can see that here. So really leading the charge. Europe did lag behind, down about 1.5% on the week, and then China really getting whacked, down 5% on the week. Looking over at commodities, we did see quite heavy metals complex. Copper actually managing to finish flat, but precious metals were down. Nat gas also down with uranium, but oil managing to stay in the green. There's an OPEC meeting coming up on the 4th. The Saudi oil minister has been warning the shorts that they might have a painful time. So that's kind of got the market a little bit nervous about what they're going to come out with there. Even if we do see a short squeeze, like we saw in the production cut before, looking at the trend in this thing, it's probably an opportunity to sell. So right now, I'm not doing a lot in oil, but if we were to get a pop on OPEC trying something on oil, probably is an opportunity to sell into if you think about it. Looking over at the other stuff, FX dollar grinding out some more gains along with yields. We saw TLT getting down near that 100 level, did manage to bounce a little bit at the end of the week. And then sector-wise, everything kind of in the red. ARC was managing to hold on to some green until later in the week, got hit. Obviously, couldn't manage to really rally with the AI stocks because the ARC basket no longer contains Nvidia, which I'm sure Kathy Wood is not over the moon about. Looking over at skew, it kind of finished the week fairly flat. Europe was catching up a bit with a slight bid. US S&P and Russell skews kind of where they were. Obviously, the debt ceiling deal looks like it's done over the weekend. It's going to have to go through Congress now. And then that skew and that vol is going to start to reset lower if we do get that through Congress. Looking at Nasdaq skew, on the other hand, that's on a 4 handle. Clearly, people getting a bit scared of the upside in tech and how fast this thing's going to run away. So in general, that skew flattening versus other indices. Looking over at vols, we did see a bid on vol in the Nasdaq, up 2 vols on the week, with spot up 3%. So definitely seeing a bit of a change in the skew and the way that's behaving in the Nasdaq relative to everything else. Obviously, spot was down in Europe and vol was up. That's more normal. You tend to see that in equities where spot goes down, vol goes up. When spot goes up, vol goes down. So a bit of a divergence there between how the Nasdaq vols are performing relative to other indices. Looking at vols in commods, we did see vols lower in the likes of gold and silver, a bit higher in copper, and then carry-wise, looking over, we are seeing a fair amount of red now. So negative carry in equity indices in Europe and the US, still positive carry in Asia for now. So that Nikkei vol popped all the way up to 17.5, not managing to realize. So you would expect that to come back under pressure again. And then we're seeing most of FX in green, big green in TLT, really struggling to realize there. TLT's kind of been hugging that bottom end of the range, but not really moving that much. And then in sectors, most sectors in green as well, except for ARC, which has been moving. Okay, that's a summary for what kind of went on last week. All right, moving on. So sell the news. So that's the big question, right? Finally looked like we've got a compromise on the debt ceiling. Need to get it past Congress this week. Whilst there's a small chance that they don't get enough votes, some of these, hardline Republicans are saying that it's a load of rubbish, the deal, and he's basically compromised too much in terms of McCarthy. We'll see what happens. But in general, I mean, they should know that if they don't pass it, markets are going to react pretty damn badly. Whether they care about that or not, well, we're going to find out this week. Now, even if the political drama is over, the fact that the US Treasury now needs to rebuild their TGA, which is run down to near zero, that's what all the macro pundits are now talking about, calling for significant headwind to risk assets because they're going to drain liquidity over the next few months. And that's really the question. Now, it's a bit technical in terms of whether the liquidity drain is really going to impact markets that badly or not. It kind of depends on what money market funds do. And in the reverse repo where they park a lot of money, that really does depend if that moves. If that doesn't move, you might find that the impact isn't that much. That's something Macro Alpha has been talking about. I'm not smart enough to know how these monetary dynamics work. All I know is that the recent crowding into tech longs is pretty damn extreme. So you can see here, these are NASDAQ longs, which are looking pretty extreme. You look at the ratio between the NASDAQ and the Russell, it's up here, which is kind of tech.com bubble type extremes. So that, to me, if we've learned anything from this year, it's that narratives can switch violently. And this narrative is getting a bit consensus about own tech, own AI. That's the only place where the growth is. So that does make me slightly concerned. So I'd be careful on getting yourself too over your skis long tech at this current juncture. Okay. So I agree it may well be a sell the news event, at least in the short term, because things look pretty frothy. Okay. And you can see that, right? We've got the debt ceiling deal and the knee-jerk reaction actually hasn't been that big in terms of stocks, right? So the question is there really any buyers left, right? Or has everyone already kind of covered their shorts because it looked more and more like a deal was going to get done? All right, what else are we looking at? China. So obviously you've had obviously the US market rallying and the tech rallying, but China's really struggling, right? We have an exodus out of Chinese stocks that continued, fastest pace in probably 3 or 4 months in terms of hedge funds liquidating and getting the hell out of Dodge in China. We came in very optimistic, obviously, at the start of the year about the China reopening, but since then we are disappointing economic numbers, weak confidence from consumers, property market issues remain, geopolitical tensions with the US, and it's just a long list of issues making investors less optimistic on China. Okay, in terms of technicals, we had that big run up since late last year. And now we've had this kind of textbook ABC type formation. Maybe it's got a little room to go to the bottom of this level to fully retrace the 61.8 retracement of that entire rally. But it's in that zone. When it gets in the zone of 50% to 61.8%, that's already kind of, for me, done enough, I think. So I wouldn't be surprised if this kind of correction does end soon and we at least do get some sort of technical bounce, tactical bounce, that is. I don't know if the structural issues are going to go away in China. The CNH, the way the currency's moving suggests they've got problems. But I do think, though, things look oversold. We look at the momentum indicator is kind of holding the line there in terms of on the support level. And the fact that positioning's getting flushed out makes me think a tactical bounce may be in order. Also, our strategy compass is in buy call territory in terms of FXI versus all of the other indices are in buy puts. Or straddles. So in general, it is the outlier China here. It's definitely out of favor. It's definitely out of consensus. So these are the type of things that, from a tactical perspective, could set up quite well. And we think that's what we're looking at, basically. Looking at a bit more detail at the strategy compass, we see that vol carry is pretty neutral, slightly positive, but it's in the 51st percentile. So not too much concerns about owning outright options. You look at the curve here as well. It was inverted. It's much more flat now. So nothing really telling us to stay too clear of vol. You look at the implied vol. It's near the bottom end of the range. That's why we're here in buy calls anyway. So we're generally thinking owning outright calls for a tactical play does make sense, and it gives us the most flexibility to monetize, right? All right, that's the tactical trade for today. I hope you guys had a good long weekend. And I will catch you all tomorrow. Thanks.